Hi everybody, Thomas Moore at Rebel Income. You've heard me talk about how important dividends are to the Rebel Income system. They're the first filter I apply to the market to narrow down the stocks I'm willing to consider for the trades I place in my Rebel Income trading alerts. I care less about how high a dividend is than the fact a dividend is paid, because the dividend by itself is a good first stage indicator of fundamental strength that separates a company from the rest of the market. That's because less than a third of all stocks listed on U.S. exchanges pay a dividend of any kind. Another important question, however, is how sustainable a stock's dividend actually is. It's easy to think and tempting to believe that the higher a stock's dividend is, the better. I've learned through experience that if paying that dividend forces the company to use money that is better spent on its day-to-day operations, you'll usually find a lot of other critical problems going on as well. That's why sustainability of a dividend is another question that factors into my fundamental analysis. With that in mind, let's talk about AT&T. One of the biggest telecommunication companies in the United States is another highly recognizable name with a history that stretches back to the earliest implementation of telephone systems. It's also undergone multiple transformations in its history, from the breakup of the Bell system in the 1980s to the rise of wireless cellular services, and the company's expansion into a multimedia conglomerate in the 2010s with the acquisitions of DirecTV and Time Warner. More recently, the company has been transforming itself yet again, divesting media properties including DirecTV and Time Warner and putting its focus back on its core telecommunications business. That process included merging Time Warner with Discovery Incorporated into a new company, Warner Brothers Discovery, stock symbol WBD. That merger was completed in 2022 and necessitated a cut in the stock's dividend, which had been increased for 35 consecutive years prior and dropped the company from the elite Dividend Aristocrats list. The dividend's payout, even after that process has been completed, is enough that it still translates to a highly attractive yield that's tempting to consider the stock as a reasonable substitute for bonds. It goes back, however, to the question of quality and sustainability. Having been forced to cut the dividend as part of the merger and spinoff of WBD, is the company's fundamental strength sufficient to suggest that the dividend is sustainable? For that matter, does the stock offer a good value at its current price? Before we dive into the details, I want to take just a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis and search for the trades I published for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions and current market conditions. You'll find the link to that page in the description area for this video. Take a look. I know you'll find something you'll be able to use in your own trades. AT&T is in the midst of a long-term downward trend, which we can see being reflected by the 200-day moving average, which is clearly sloping downward. However, since October of last year, the stock has also been rallying into a short-term upward trend that peaked at the beginning of the year at around $17.50. The stock has been trailing back from that point, but more recently appears to have found a stabilization level in the neighborhood of $16.50 per share. That's a little bit above the 200-day moving average and looks like it could be offering some solid support right now and potentially a new buying point within the short-term upward trend that could create a new opportunity to jump in, hopefully, to see the stock push above $17.50. If it can manage to push above $17.50, the next question, of course, as always, is to think about how much upside there may be. This is one of the things that I like to try to use to identify how much reward to risk a stock may offer in the near term. There is quite a bit of pivot activity early in 2023. This is a really ugly line, but in the neighborhood of $19 per share. So about $1.50 of upside right now in the stock. If the stock were to break below that current support at around $16.50 and drop lower, next support looks likely to be in the neighborhood of the 200-day moving average. That price looks to be a little below $16. We'll go ahead and call it $15.80. That means that in terms of reward to risk, there's about $1.50 of upside to about $1 of downside. However, if you shift the perspective to think about where the stock is currently relative to some of these levels. With the stock at around $16.50 right now, there's about $1 of upside to first resistance and then about another $1.50 after that. That means that if the stock does bounce and start to rally off of current support, there could be as much as $2.50 of upside against that dollar down. That puts reward to risk at about 2.5 to 1. So if you're willing to work with a little bit more volatility and see some increased buying activity as the bounce starts to happen, then that could mean that there is more opportunity, and that could translate to a pretty attractive near-term trade. The technical setup is important in terms of making a decision about whether or not you want to initiate a new position right now. Going back to the original question, however, of whether or not AT&T's dividend is sustainable, we do need to go back and dive into the fundamentals. One of the strengths of AT&T's fundamental profile is their free cash flow, which we can see was $19.8 billion in the last quarter. This is also a significant increase throughout the past year from a little under $16.2 billion 12 months ago and a little under $18.3 billion in the quarter prior. It's a useful sign of increase that implies the company's profitability is improving overall. Liquidity over the past year has also improved. We have $7.5 billion in the last quarter compared to $3.7 billion 12 months ago. Now that said, there is a decline from about $9.5 billion in the quarter prior that is interesting to observe. But the more important pattern is the increase over the past year. It's a sizable improvement of more than 100%. AT&T has carried a lot of debt for a number of years, even before it purchased Time Warner. However, with that in mind, we do see that long-term debt is $126.7 billion. Even after the spinoff of Warner Brothers Discovery, AT&T was left with a significant amount of the debt burden of that original acquisition, which we can see in this number. That number has declined, however, over the past quarter and the past year, which were both at around $128 billion. The increasing free cash flow pattern is also confirmed by a significant and major reversal in company's profitability as reflected by net income. Over the past 12 months, this number was a negative 8.74%, but increased in the last quarter to more than 11.5%. That's a reversal of more than 20% in the most recent quarter, and that's a solid sign that the company is reversing a pattern of spending more money than they were making and is returning back to profitability. This is all important in trying to evaluate whether or not a stock's dividend is sustainable. With that dividend in mind, we can see that the stock's current price at $16.70 against that $1.11 dividend translates to a very attractive, higher than average dividend yield of about 6.65%. Typically, if a dividend is in the average range for most stocks in the S&P 500, which is between 2.5% and 3%, then the question doesn't come up as much. But if you start to see a higher than average dividend, what looks like to be a little bit of an outsized dividend, then it becomes a more important question. In the case of AT&T, as I mentioned at the beginning of the video, they have had to decrease their dividend. We can see that pattern here on this chart. The company had been following a very consistent 2% increase each year, 2016, 2017, 2018, and 2019. 2020 and the pandemic, they suspended dividend increases. They paid out the same dividend in both 2020 and 2021, and then reduced their dividend in 2022, which is what pushed them out of the Dividend Aristocrats list. They also reduced that again in 2023 from $1.35 to its current level at $1.11 per share. One of the reasons that a company will reduce its dividend is in order to save money for other operations. And in this case, for AT&T, the dividend cut was necessary in order to facilitate the spinoff of Warner Brothers Discovery. That obviously has an impact on shareholders. However, the net effect is about the same as what the dividend yield was before the spinoff at the stock's price at that time, and generally suggests that the dividend should be sustainable. I mentioned already that the stock's dividend yield translated to a useful annualized yield of 6.65%. However, the company's value proposition right now puts a fair value target a little below the stock's current price at $15.62 and a useful discount at around $12.50, which is why right now AT&T is actually overvalued by about 6.5%. So buying the stock for its dividend is basically coming up sixes in terms of looking for any kind of long-term price appreciation. Under the best circumstances, I like to look for a stock that is paying a useful dividend and is offering an attractive value proposition of 15 to 20% at a minimum. That means that right now AT&T is just not a great buy. Thanks everybody. I hope you found this to be useful as always. If you like this video, please do go ahead and subscribe to my channel by clicking on the link shown right here. You can also check out this video to learn more about the Rebel income system, as well as to see other examples of the kind of content you'll see me post on this channel. Thanks again. I'm Thomas. Talk to you again soon.